This is Bob Brooks, host of the Prudent Money Radio Show. Just got off the air. Wanted to introduce you to who's going to be on the program today, Mark Pfeiffer. He's our mortgage expert that comes on once a month. And I got to tell you, some questions I ask every program. You know, how are the real estate markets looking? What's the mortgage rates like? You tell us what you're seeing? I mean, because he's on the ground level like a lot of people are that work real estate. I thought today was absolutely interesting because so many things came together. We looked at the wonderful world of real estate from a lot of different angles, and I think if you are even remotely in the market for a home, you need to listen to this because I think it's great information. And if you got a question for me, please go to the website at prudentmoney.com. If you want to talk a little bit about financial advising, I'd love to talk to you about that. Just send in an email to info@prudentmoney.com. This is Bob Brooks. Have a great rest of the day and keep the faith.
91.3 KDKR Decatur, Dallas Fort Worth, and 91.3 KYJC Commerce.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, so the Fed raised interest rates. What does that mean to you? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, in a much anticipated move, the Federal Reserve Board raised interest rates by 1/4 point. Mark Pfeiffer is here today to weigh in. Mark, it's great to have you on the program, as usual.
As usual, Bob, you are correct. It is good to be here.
You know, I was thinking about you and I having had lunch one time. I don't know if you remember this. And we started talking about the Federal Reserve Board and interest rates and all this kind of stuff. And we were kind of geeking out over the numbers. And that just comes to mind as we actually have a program on the same day that the Federal Reserve Board actually made a decision. So it gives us something to banter back and forth for sure. You know, I guess the real question is, you know, should they have taken a pause? Because to me, they're sending a confusing message. And it's kind of one of those things where I don't think a quarter, if you're really convicted, you really want to slow down the economy, do something more than 1/4 point that doesn't even move the needle. It just doesn't make make sense.
Like death by paper cuts is what it's happening here versus just, fix the problem. So I agree. They've kind of waffled in the last, 12 months, give or take. I mean, obviously they were slow to start raising them in the beginning. And they've obviously, look, it's the fastest they've raised rates as a whole, like over the last year and a half, whatever it's been. No question, it's the most they've done. But I agree at this point in the cycle, either just, kind of finish it off. And I agree with you, either do or don't. And so the problem is last time they decided to wait and hold off. This time it was forecasted. We all knew the quarter was coming. And I have the Fed minutes, pulled up for the statement they released, and they've changed all of 3 words in the statement from this time to last time, right? And so it's just they're going to continue to assess the additional information as it comes in. So honestly, what I've seen, I think they're projecting they be in the market and kind of what they're projecting even one more 1/4 point raise. But to your point, I kind of wish to some degree just do 1/2 point now and then push pause for a while and see what happens. Because it does take about 6 to 12 months for this to cycle through the economy.
I say take a full point, knock it out.
Punch them in the nose.
it would be a gut punch. And I think after you said I'm going to raise it at a full percentage point, we're done. Because that's the other thing that's so ridiculous is that they are so close to the point that they want to be. I don't know. I guess it's what's interesting to me is that Jerome Powell has a couple of meetings ago was seen very pleasant, very encouraging. Today he's kind of like, my tone has changed. So it's really hard to follow sometimes.
Well, I know Jim Cramer, I'm a big Cramer fan. Just I find him entertaining, and I think there's nuggets, and I'm not trying to start anything here, but at CNBC, he said the same thing, and this is 6 months ago, even a year ago. He just said, give us 1 point at a time. Like, just punch us in the gut, let's get over it, and move on, as opposed to drag this thing out to be this long, drawn-out guessing game. So I agree with you. I don't know if I'd agree with the full 1 point today. It would certainly be a fun conversation. But yeah, I think at this point, truly, from what I've seen from a inflation part, I know you and I've talked a lot about inflation. The reason why they're doing this, for those that don't know, when the Fed raises rates, they're trying to cool off the demand, right? They're trying to just make it to where not everybody wants to go buy stuff, and they want to make financing a little more expensive to then hopefully cool demand, which then has inflation coming down. Well, the problem is all the data they're looking at is old, right? But the trend, I mean, we've already cut inflation more than half. It's already gone from basically the high 8s to 9%, depending on which number you look at, down to the 4s. So they're making wonderful strides. I think at this point, let's give the medicine time to work. I mean, think about it. If you're in the hospital and you don't feel well, the doctor doesn't just sit there and put a pill in your mouth every 30 minutes, right? You got to put one in and let it go through the system and give it time to work. And I think the Fed's just not giving their current actions enough time to kick into the economy. So I hope they're getting close to done, and I agree. I mean, just be done. But, I unfortunately think it's going to kind of drag out for the next 6 to 12 weeks of, do or don't they, keep raising up a quarter of a point.
So let's talk a little bit about mortgage rates. I know that there's not a day or a minute that goes by that you don't glance at them. Talk about what they were doing leading up to this announcement and kind of where they settled following the announcement.
Yes, what's interesting, and I'll back up a week or two just to give you some background. For the entire month of June, it was very boring. I mean, almost nothing happened. It was an anomaly. That's not typical. The market kind of just moved sideways, a little tick here and there, but nothing major. And then about 2 weeks ago, July 4th, the first Friday of the month, when that week job reports came out, and it showed big numbers. And big numbers, again, is inflationary, because when it's hard to find jobs, or when it's hard to find labor to fill those positions, you got to pay more, which is going to be inflationary. So, man, the mortgage rates got kicked in the gut. It went from what would have been a mid to high 6 to suddenly back in the high 6, low 7s. And we've since recovered a little from that. Some positive inflation data certainly helped. So I would just tell you that generically speaking, rates are still kind of in that high 6, low 7 range. Like if you just go to a couple different sites that I like the source, it's not saying this is the rates, but FreddieMac.com shows rates at 6.78. Mortgage News Daily shows 7.04. So they're still up in that high 6, low 7, which I'll be honest is higher than where I'd expect them to be right now. But again, I do have confidence and faith that over time, as inflation continues to subside, I think they can and will be coming down here over the next 6 and 12 months.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. Mark Pfeiffer's here to talk a little bit about mortgages and real estate. If you want more information, you can go to his website, www.mortgagemark.com. What do you think is the sweet spot where, as far as mortgage rates go, that once you kind of get past that point, everything loosens up a little bit?
I think something with a 5 in front of it. The reason why I say that, a while back there was a CNBC article, and we're talking, call it a month or two. There's a CNBC article that says like 78% of the home buyers on the sidelines, whoever they surveyed. So I'm assuming it's more than just 3 people, right? So take a big survey. Like 78% of them said 5.5 is their strike price to buy. So I think if you get anything with a 5 in front of it, it creates that frenzy. But I'll tell you, the reality is the housing market is still very, very good. I mean, we are literally back to all-time highs in some markets for prices. So those folks that are waiting for rates to go down, my goodness, like the average, and I pulled it up just so I have it. I saw this literally today. This came out this morning that I saw, but call it Case-Shiller, CoreLogic, Zillow, Black Knight, and FHFA, which is Fannie Freddie. The lowest number for the 2023 appreciation is 5%. The highest is 10%. So 5, 7, 10, and 10 are the numbers. So when you think about that, while rates, people say, oh, that 5 point something is when I'm going to move and do something. Oh my gosh, like it create more buyers in this already like tight supply market prices are just going to keep going up and up and up. So I'm of the opinion that, the right time to buy a house is when you need one, and I wouldn't let rates deter you from doing that. So as far as where does the frenzy start, Bob, or where do people come off the fence, I think it's probably a 5, but the prudent buyers, man, they're buying now because prices continue to just go up, especially here in North Texas.
Yeah, and I got to think that the last thing that and you tell me, I got to think that the last thing the Fed wants to see is a return to 2 years ago in the real estate markets.
Yeah, and truthfully, they don't even like it the way it is. I can tell you that. I mean, we don't like it either, right? Affordability is a real problem, right? Houses, the average home price here in Dallas-Fort Worth, I mean, it keeps going up and up and up, and I think it will. And you don't want to end up like the San Francisco market where it's $600, $700 just to get into a starter home. So I don't like it, and I agree the Fed doesn't want that. But the reality is there's just not enough homes. Builders can't put homes on the ground fast enough to create the supply. I mean, nationwide, you're looking at less than 1 million homes for sale. And when you think that 25% of them are probably sitting there as new construction or you can't live in them, that's a really tight supply for the millions and billions of millennials that are coming to buying age right now that need homes.
So what have you seen as far as the rental market for those people who need homes but are having a tough time stepping up to the plate and paying what they may have to pay? What are rental prices looking like? Not so much, I don't know if you've seen these statistics or not, but not so much in apartments, but in homes.
Yeah, the single family, I will say that is part of the reason why inflation has been coming down, is because that rental market, a lot of investors are now on the sidelines with rates at 7%, and that's for an owner-occupied home. So figure, if I'm an investor, I could be paying a rate significantly higher than that or way more money, where now the cash flow is not there. So the investors, a lot of them have just pulled off and decided to hang tight just because they can't make the finances work. And I know just from a demand standpoint, it just makes it to where that the ridiculous, because it used to be during COVID and right after, year over year, rents were going up literally 18 to 22%. Now it's getting back to some normalized amount where it's closer to like 6-ish, 8-ish. I think that's still hot, right? It's still coming down, but at least the renters are able to, still, hopefully more afford as opposed to a 20% increase. But to your point, Bob, I don't want to say it's cooling off because, again, more and more people, the average millennial age right now is getting that point of being in their mid-30s, and that's on average, I think the average age for buying a home is like 34 years old. Mm-hmm. People have kids. That's a catalyst. So right now the renters, they're not getting beat up as much as they used to, but it is a big jump to go from renting to buying with rates being at 7% right now. So it's a real thing, and I don't know how to fix that affordability issue outside of just build a whole lot more homes.
So one of the ideas that we've talked about that I know that you're a big advocate of, and it does make sense, is to go, you buy at these levels when rates come down, you refinance. How would someone manage that? I mean, is there a rate that once you, and this could go back to my sweet spot, what I was talking about a second ago, but is there a rate that you cross that you go, it really makes sense to go ahead and refinance?
Yeah, and again, to answer it generically, obviously every situation is going to be different, right? You and I both know that. But to your point, yeah, let's just assume it's a 5% appreciation. So let's just say you buy the house today at a 7% rate, $500,000, and we just recently did the math on this type of example. If you do the math and say, okay, today's $500,000 home, next year that could be a $525,000 home at 5% appreciation, right? And that's the lowest of those numbers we have. In some parts of Dallas-Fort Worth, it's already back to getting crazy. So the cost of a refinance for that type of home, that type of loan, generically speaking, if you're in my compliance department, sorry, but the reality is the average cost for a refinance, I'm going to ballpark for a home that size, and it's probably like $4,000. Mm-hmm. So when you figure if somebody can get in the rate, get in today with a rate of 7%, you only got three things rates can do. They go up, they go down, they're the same. So if somebody buys today at 7% and they buy that $500,000 home, 12 months from now, that home could be worth $520,000, $525,000, whatever it is. If you got that 4 or 5% appreciation, you just made $20,000 living in a home. And if you have to spend, then rates go down. So at what point, if rates are at 7, maybe even a mid-6, right? If you can get something at 6.5, if it financially makes sense, and talk to a mortgage person you trust to make sure the numbers do. But even if rates go down that 0.5%, you can start saving some money. And now, by the way, you got so much more equity. maybe you paid mortgage insurance, and maybe that gets to get reduced or even go away, depending on how you finance it. So I always tell folks, look, if you think rates are going higher, that means this is a great time to buy because this is the lowest rates are going to be. If you think rates will go lower, great, get in today and refinance later. Either way, you're still ahead after the appreciation gets factored in.
You know, one of the segments of the market that we hardly talk about is the builders. Talk a little bit about how they've really held up. I mean, you've got a lot of cross currents from, prices starting out at one level at a new build, and then by the time they're 2/3 of the way through building the house, the prices have gone up. I mean, how have they fared?
It's kind of, that's a loaded question. So, in the recent, call it 12 months, right? So last year, rates were on a tear. Everything was going fine the first 6 months, and all of a sudden, just things hit a brick wall after July. Rates were suddenly got to that point to where suddenly there weren't as many buyers. Builders were caught having so much inventory because, again, as I mentioned, they're trying to keep up with demand. So all of a sudden, there's this, the market gets quiet from a buyer perspective for a few months, and builders are sitting on a glut of inventory. So what that means is at that time, they stopped building specs. They stopped building homes thinking somebody will buy them. They just left the dirt. And now, after that 3 to 6 months, after all that inventory got sold off, as of January this year, the ones I know, and we work with a handful of great builders here locally, basically as of January, when all their inventory was gone, that 6 months got sold out, they started raising prices again. This time, some part, not so much because of inventory, but just to get things back to where they were because they cut prices so much. That's what people thought prices were, quote unquote, coming down. Last year was still up for 6% appreciation. So the builders right now, again, they're just trying, their biggest challenge, in my opinion, is trying to put an affordable home on the ground. The problem is things are still tight. Labor's still expensive, lumber's still expensive. So they're trying to make a home affordable while building a good home, but something that somebody can afford and be in. So it's quite a challenge. I mean, and right now they're not building, just an excessive amount of homes. Most of them are waiting until they have contracts on it. So it's still a really tight supply, and I suspect it will be moving forward. But for their sake, things have gotten back to somewhat normal where they're not having these wild fluctuations in cost during the process.
So it seems to me like that maybe a year ago there was excess inventory, but today not the case.
Yeah, not excess. It was literally it was for about 3 months, maybe 6 at most. I mean, think about this. A lot of the builders, especially the public ones, they have to report quarterly. They don't want to be sitting with all this inventory that's just eating away at their carry cost. So they just got rid of those homes. Like I remember talking to one builder, or somebody trying to build a home December 8th. And the builder literally told them and me, if we can't close this by the end of the year, the price goes up $10,000. And it wasn't for any other reason than they were just trying to unload that inventory to make some quarterly numbers so that they can look good when they report, for shareholder purposes. But all the glut that was there, it was only about a 90 to 120 day glut where it's just they got caught with a demand that dropped off a little. So once they got rid of that, now it's back to business as normal, and they're building as demand it comes in. But what it means is you just don't have a ton of homes sitting around. So supply and demand kicks in. The builders don't have a ton to sell, and as I just mentioned, there is a housing shortage, and that's what's going to keep these prices still going up for the foreseeable 2, 3, 4 years from now.
I got to think it's got to be tough to be a bank or a mortgage lender just because you're kind of dancing that dance. Today it's worth this. 2 or 3 months later it's going to be worth this. And it's in a situation where you're building a house, does the builder commit to a certain amount of capital up front? I mean, it's interesting because we've never really talked about this. But do they? I mean, talk about the process and what you have to go through if you are going to work with a builder to do a new build.
Yeah, so let's talk about a builder that builds a critical mass of homes that builds 50 plus homes a year, whether it's 100, 150, 200. There are builders that do only 3 or 4 homes a year. They do the custom; they're really big. That's a different animal. But in general, let's just say you got a home builder that builds 150 homes a year, which is a lot. They do need to go to the bank, and they do need to put money down. And if there's a contract, so let's say the Smiths or the Joneses are buying this house, the bank's going to give that money knowing that there's already a committed buyer, right? And so they'll still require the money from the builder, but they'll have to do it. Now, the builder needs maybe and this is where the banks have tightened up on the builders. This makes it hard for builders where the banks say, hey, I don't want a lot of risk, where you guys are sitting there holding too much money. It used to be they'd say for every one contract or every two contracts, I'll let you build a spec, meaning we hope somebody buys this thing in the future. That's gotten tighter now. Now they may want, again, instead of being 1-to-1 or 2-to-1, I've heard, and again, I'm not a builder, but I know they're having to basically just say, okay, the banks have tightened up and won't give them as much money per spec. We're requiring bigger out-of-pocket from the builder up front because they are worried about potential prices on those homes. So yes, it's a real thing because, and this is the other part. Think about this, Bob. If you're building a home and you're the first home to be built in that neighborhood, in that community, they've done market research, but there's no guarantee that if they're going to try to market this thing for $450, that they can find a buyer for $450. So that's what a ton of risk, right? And that's where market research pays off, and it works. But it's a lot of risk for both builder and bank.
So have you seen, or how many situations have you seen where some of these just really just blew up, these deals?
Not a lot. And again, to everybody's credit, builders and banks. The banks have, especially back in March, I think it was, when Silicon Valley Bank blew up, those banks within 30 days, the ones I knew, they tightened up super quick. And again, a lot of that impacted more of the smaller builders, the ones that have had relationships and have done this, and the builders I work with are established many, many years, and they know what they're doing. But the reality is it certainly just made things more expensive. And then when the Fed keeps doing this, like today's rate hike, it doesn't affect the consumer or me at this moment, right? What it does do is it affects anybody with a line of credit, like a builder, or somebody paying like prime plus something. So their cost of borrowing just went up. So whether or not these builders bake that into their new pricing to be determined. But yeah, they do, like I said, it's the banks and the builders, they've all gotten a little wiser, and it's not quite, getting caught off guard when this happens, at least not in my experience for the ones we're working with.
So I guess you would say, you could come to the conclusion that it's just a totally different environment, totally different way of doing business. And if you, as a lender, you've really got to adapt.
You really do. I mean, again, my world, to some degree, it's, whether they buy from Joe Homeowner or Joe Builder, the biggest part is just that appraisal, and that's us, helping, just educate both the builder community and the appraisal community to say, let's understand what a new construction appraisal looks like. That may look a little different because it's going to use different data points because it's new. But as a whole, from a mortgage banker standpoint, it's not that big of a deal. I mean, there are certain little things as far as paperwork, but I would say the real change is in the banking system. The banks, the bankers out there that are giving money to the builders, man, oh man, you got to be on it. And I know one or two banks that got real conservative and about 6 to 12 months ago started tightening up their guidelines, just knowing that they're into this cycle of the boom cycle, and they've already started tightening their guidelines. So I give credit to the bankers and the builders. Again, you're not. Most bankers and builders remember 07, 08, and they haven't gotten quite. I mean, that scar tissue is still there, and they've responded better. So I think this one, again, there's probably some folks that got caught, but I'd say the established ones that have been around, they've done great navigating these troubled waters lately.
So let me ask you this: we've got about a minute left here, and I'm just curious. And the answer, if you don't have an example, that's fine. This is kind of catching you off guard. What mistake do you continually see people make that in the back of your mind you're thinking, really, with all the education that's out there now, you really still shouldn't be making that mistake?
Just in general, from a loan standpoint,
yes.
I think it's we're going to wait. And so, I mean, and I don't, people are like, oh, that's self-serving. No. If you want to buy a house, buy a house. The time to buy is when it makes sense for you in your lifetime. Don't let rates dictate what you do. Because the people that said, oh, I'm going to wait for rates to come down last year, I'm not making this up. There's facts. This is stats. 500,000 is today's 525,000. So people are making 20, 25, 30, 40, $50,000 mistakes saying, I'm going to wait. Buy the house when you want to buy the house. If you can and afford it, obviously. But I think the biggest thing is, buy when you need and want to. If you're an investor, it may be a different story, but just trust. I mean, these are facts. People who don't pay attention to the headlines is probably what I'm saying is don't pay attention to the headlines. Look at facts and make your own decision.
Mark, always good to have you. If you want more information on Mark, go to mortgagemark.com. Mark, thanks a lot for being on the program, man.
Thanks, Bob.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. I've had Mark on very many times, a lot of times, excuse me. And it's just amazing to me how things have changed over the years with this real estate market. This is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.